This next video is on the as part of the FASB's conceptual framework, talks about the component of the qualitative characteristics of useful information. So if we go back to the overall structure of the conceptual framework, again we see the structure that was presented in our previous video, and right at the top we have the objective of financial reporting. We've talked about that in the previous video, and this objective drives all the other elements in the conceptual framework. So now we're going to talk about the qualitative characteristics of useful information. Now the first thing the conceptual framework addresses is the concept of user understandability, and that means that the users, those key stakeholders, must understand the information within the context of the decision being made. This user-specific quality, it's a user-specific quality because users will differ, obviously, in their ability to comprehend any set of information being presented to them. And again, what we said from the previous video is that the objective is to provide, the objective of the conceptual framework is to provide comprehensible information to that set of users who have a reasonable understanding of business and economic activities, and they're willing to study the information being provided. Now, the other overriding concept in the qualitative characteristic of useful information is the concept of information or decision usefulness. And decision usefulness is the that information's ability to be useful in decision making. If it's not useful, it's really not it's not the type of information we would call qualitative for decision making. So let's go on to the next slide and take an overview look at qualitative characteristics of useful information as defined in the conceptual framework. And again, we can see what we just talked about. User understandability leads to decision usefulness. We'll talk about the constraints a little bit later on, but now we're going to talk about, again, decision usefulness, and that's basically the ability for that information to be used for useful decisions. And there are two basically primary qualitative characteristics of useful information, and those are relevance. In other words, the information has to be relevant to the decision, and reliability. In other words, the information has to be reliable also for the decision. In order to be relevant, information to be useful has to have, in effect, a predictive value. And for example, if net income and its components confirm investors' expectations about future cash generating ability, then net income has a predictive value or a feedback value for investors. This type of confirmation can also be useful in predicting future cash generating ability as expectations are revised. Now let's take a look at the overall view of the qualitative characteristics of useful financial information. Again, we start off with user understandability, and then we go to the concept of decision usefulness. Now, in order for a decision to be useful, it has to possess two major qualitative characteristics, and one being relevance. In other words, the information has to be relevant to the decision, and two, reliability. Even if something's relevant to the decision, if the information isn't reliable, it's really not useful to the decision. So it has to possess both relevance and reliability. To make a difference in the decision process, information must have a predictive value and a confirmatory value. Typically, it has to have both. For example, if net income and its components confirm investor expectations about future cash generating ability, then net income has a predictive and a confirmatory value feedback for investors. Timeliness is also a very important concept to relevance. Information is timely when it's available to the users early enough to allow it for use in a decision process. The need for timely information requires that companies provide useful information to external users on a periodic basis. Example of that, the SEC requires its registrants to submit financial statement information not only on an annual basis but also on a quarterly basis. The other component under decision usefulness is reliability, and reliability is really is the extent to which information is verifiable, has representational faithfulness, and is created neutrally. The first element is verifiability, and verifiability implies some form of consensus among many different ways of measuring something. You know, a good example of that is, let's assume that you buy a piece of land, and according to accounting principles, you record that at historical cost in the balance sheet. Now, under these conditions, that cost is really pretty highly verifiable because the cost can be traced back to an exchange transaction to purchase the land between a willing buyer and a seller. Now, on the other hand, if you try to value the land at fair value, that value is a lot more difficult to verify because you could have several different appraisers and all of them are going to have a different assessment of fair value. The next element of reliability is what we call representational faithfulness, and what that really means is it is what it is. Maybe this is best described through an example. Let's assume that the term inventory, which is on a balance sheet of a retail company, is understood by external users, those third-party stakeholders, to represent items that are intended for sale in the ordinary course of business, in other words, retail. If the inventory on that balance sheet also includes values of machines used to produce inventory, then it isn't what it really is, and that means it lacks representational faithfulness. Several years ago, accountants typically used when we created some type of form of estimate of bad debts. Accountants used the term, when that allowance was created, reserve for bad debts. And the problem is that lacked representational faithfulness, because a lot of people, the implication is reserve means money is set aside. And now that has been changed now to now allowance for bad debts. The last item of reliability is what we call neutrality. Neutrality means that the information being produced is neutral with respects to all of the parties affected by an accounting rule. And the problem is that neutrality is very, very, very highly related to the establishment of overall accounting standards. You know, you already know from your accounting text and accounting courses that the way an accounting standard is applied can have good effects or adverse effects on certain type of economic entities, and also then their investors and their creditors. And that's really difficult in the standard setting process to create some rule that is so neutral that it can apply without adverse or good effect to all economic entities. In theory, neutrality should mean accounting standards and the information it produces should be established with overall societal and business goals in mind. It should not try to be political. In other words, should not try to favor particular groups or companies. The conceptual framework also identifies two other secondary qualities in decision usefulness, and those include comparability and consistency. And if we look at these two secondary qualities, comparability is the ability to help users see both the similarities and the differences between events and conditions. We've kind of discussed the importance of the ability of stakeholders, investors and creditors, to compare information across companies to make their resource allocation decisions. Also closely related to comparability is the notion of consistency. And that means consistency of accounting practices over time periods for actually comparison purposes. If we keep changing, or if an organization or the FASB keeps changing accounting standards, that can damage the comparability and the consistency of information and make it less useful. Now, there's a couple of other factors that can affect decision usefulness, and we're going to call these constraints. And the first constraint is cost effectiveness. We can make information more useful and useful by refining it, but it goes to a certain point where the cost of producing that type of information far exceeds the benefits in terms of decision usefulness. So in some cases there are limits to what we're going to do regarding information and its usefulness for decision usefulness, just because of the cost of producing it. Along with that is the concept of materiality. Again, a $5 item in the financial statements, maybe that could produce some form of useful information, but by the same token, from a materiality standpoint, does it really make a difference regarding decision usefulness? And the last area is a little bit more difficult to understand because it's presented in a number of different ways in accounting text, but it's a concept of conservatism. And conservatism comes out of accounting traditions. And the best way of describing this is when you are forced, or there's several different accounting alternatives you can make in terms of, let's say, valuing a transaction. Conservatism says the accountant is supposed to pick the transaction that produces the effect of the lowest net income between the two, or the lowest amount of net assets between the two. Let's use an example of where a company has decided it needs to make an accrual based upon its judgment of a lawsuit that the company knows it's going to have. Basically, it's going to end up having to pay a lawsuit, but the lawsuit is not necessarily, it hasn't been settled in terms of dollar amounts yet. But all the criteria is there that the lawsuit should be accrued on the financial statements, a credit to liability and a debit to expense. Now, in this case, the lawyer, we can ask the lawyer, we'll say, okay, what do you think the damage is going to be? And the lawyer says, well, I think it's going to be between $50,000 and $80,000 on the outside. In theory, again, under the principle of conservatism, what the accountant would do, or the company would do, would be to pick the most conservative of the two decisions. And again, conservatism means which is going to reduce or have the largest negative impact on our net income or our net assets. In this case, we would want to pick the $50,000 because that's going to show $50,000 of expenses instead of $30,000 of expenses. So that is the principle of conservatism. Okay, now let's go on to 3 multiple choice questions, the similar questions that you could find on the. Okay, let's start off with multiple choice question 1 of 3. Which of the following does not represent relevance? And again, we have 4 choices. Stop your video, select the best answer, and when you're done with that, go ahead and restart the video and view the answer slide. Okay, number 1, which of the following does not represent relevance? And the answer in this case is verifiability. If we take a look at the usefulness decision-making diagram, we can see under verifiability that's under reliability and not relevance. So that's the answer to number 1. Let's try number 2. According to the Statement on Financial Accounting Concepts, the concept of neutrality relates to which of the following qualitative characteristics concepts? And again, with that, go ahead and select your answer. Stop the video when you're done selecting your answer. Go ahead and restart the video. And the answer in this case is, according to the SFAC, the concept of neutrality relates to which of the following qualitative characteristics concepts? In this case, the answer is B, reliability. We can see neutrality is a component of reliability. Okay, let's go on to the final question, which is number 3. Here, a company is estimating an accrual for uncollectible accounts, and its credit and collection department has determined that the estimate is between $46,000 and $58,000. Now, under these conditions, the controller records the following journal entry where they debited uncollectible accounts expense for $58,000 and credit allowance for uncollectible accounts $58,000. Then the question asks, this is a demonstration of what characteristic influencing useful information. Again, stop your video, make your choice. When you're ready to continue on, go ahead, restart the video and view the answer slide. Number 3, we had a range between $46,000 and $58,000 in terms of estimating uncollectible accounts. And in this case, the controller elected to select the upper range of uncollectible accounts, and is asked what's the demonstration, what's the characteristic. And in this case, the characteristic would be B, conservatism, which is when an entity must choose between 2 or more accounting periods. Choosing the option that will result in a lower income or lower net assets is a practice of conservatism. And with that, that's the end of useful, basically the qualitative characteristics of useful financial information. Thank you for your time.